Hello, everyone, and welcome. This is the third part of a short three-part series which highlights what we believe to be a sensible way to invest your money. Last week, we looked at 5 effective investment practices we should all focus on. Today, I want to briefly highlight how we build portfolios for our clients at Wells Gibson. What you need to know is there is no absolute best way to build a portfolio, but there are some portfolio structures that are more sensible and more robust than others. The first step we take is to address one of the biggest challenges all investors face. That is, what asset classes to invest in and what to avoid. So at Wells Gibson, we exclude those asset classes that do not contribute effectively to a portfolio structure. This is such an important first step because if you are entirely comfortable with the assets in your portfolio, you're far more likely to remain disciplined when markets are more turbulent. Wells Gibson's portfolios comprise 2 components. The first is what we call higher risk growth assets, such as equities or shares. However, to own an entire portfolio made up of these higher risk growth assets would require some resilience on an investor's part when markets are in turmoil. So most investors also require an allocation to what we call lower risk defensive assets, such as high quality bonds. We prefer these to riskier bonds, which tend to act more like equities or shares when there is a market trauma, and especially when there is also an economic downturn. That's all I want to cover in this short and third part of how to invest your money sensibly. However, if you want to learn more about how to invest your money sensibly, next week we're going to look more closely at these higher risk growth assets, which we regard as the engine room or the engine of your portfolio's returns. As always, thank you for watching. Please visit our website at wellsgibson.uk and don't hesitate to get in contact if you have any questions. Thank you.